Okay, everybody, we are 20 seconds away from beginning the session. Would you mind to confirm on the comments box that you see my screen, hear my voice, and everything is clear? That would be great. So we can have a strong beginning of the session, knowing that technology is fine. So quick message from you guys, quick hello, quick yes. Yes, we hear you, Jose, something like that, just to confirm that we are connected. Good, wonderful, guys. Wonderful, wonderful. Okay, so let me maximize here the presentation, the PowerPoint presentation we start the session with. Always, AutoUFOs get together. Today is a sharpening session. Today is March 10, 2018. And my name is Jose Blasco, which means that I will be your guide today as we continue sharpening our skills when it comes to understanding how options work. We've been doing a few sessions now, and we'll keep going because this, in my mind, is getting interesting. We started with a very foundational terms, if you wish, and things like that. And since 2 weeks ago, we started more discussing the how to deal with the options, the how to construct options positions, and so on. And that's why I'm saying that in my mind, it's becoming a little more fun, isn't it? Anyway, good to see you guys. I see your comments, your confirmations that sound is clear, you see my screen, etc. So it's wonderful. So we can start the session. Obviously, you have all noticed that we start with a few minutes of delay. I had a problem with the initialization of the room and stuff like that. So, well, not the first time, and I guess not the last time. So, let's put it on the side and let's begin our session, okay? So let's begin with a disclaimer. Anyone would like to time me to see how fast I can do it today? Let's go for it. The following videos, clips, and demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only, and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through the demonstration do not indicate in any way the results you may receive on using our products. Here we go. Yeah, I would say not bad for a person who speaks English as a second language. Anyway, a little modest myself here to start the session today, okay? But anyway, let's begin, guys. Options trading, okay? So what have we been doing since the past weeks, okay? And by the way, in the comments box, it would be great if you could write very quickly if you type yes, I did, or no, I didn't, if you have attended any of the prior sessions that we have done on options, sharpening sessions on options, either live or recorded. If you have attended any of them, please type yes, I did. If you haven't, please type no, I didn't. Okay, so that way I also get to understand a little better where you are at, and also we be able to measure a little bit more how much I may need to repeat myself or no need at all to repeat myself. So just while I give you a little time for you to type, quick super quick refresher of what we have been covering until now. When we started talking about options, we talked about what they are. We talked about the two types of options, calls and puts. We talked about the fact that you can buy calls, buy puts, sell calls, sell puts. That ended up giving us 4 different possibilities, okay? And very, very, very good, guys. Thanks for those comments there. And then we talked a little bit surface level. We'll have to come back to this and get way deeper into how options are priced. We will. We touched a little bit on the Greeks. We'll have to come back here and go way deeper into the Greeks as well. Okay, so we will do that. And then finally, 2 weeks ago, we started talking about what I called the how. How do we deal with options, okay? How do we trade options? How do we construct positions? And the 2 types of positions we started learning to build is buying a call, and then we also covered how to buy a put, okay? And actually, we did plan a couple of trades on buying a call, buying a put, and we put these trades in place and so on, okay? And we learn up to this point that when buying calls or buying puts, there is always 2 answers to be answered, okay? Two questions to be answered. That would be a better way to phrase it. And which is, what's your trading strategy and what's your option strategy? But also within the option strategy, there are 2 answers to be given as well within the option strategy. So let's begin with the trading strategy. The trading strategy tells you the when to get in and the when to get out. Okay, so the answer to your trading strategy, it's obviously your beautiful UFOs here on the screen. Okay, the green is when you get in expecting a movement to the upside. The red is when you get in expecting a movement to the downside. If it goes through, you stop yourself out. We have been analyzing multiple examples of that, so I would assume this is clear. If it's not the case, please let me know. And that would have to do with the when. Now, another thing that we have done in many sessions is to add additional rules on top of it. Okay, I never suggested to go ahead and every time it's green buy, every time it's red sell. There is more to it. We have been looking at trends. We have been looking at Fibonacci retracement lines or projections. We have been looking at how far the rival UFO is. In other words, how much money are you risking in exchange for how much money are you making? So all of this has to do with your trading strategy, which I will not get too deep into because all of us should be having our own set of rules, which is basically our trading plan. All of us use the UFOs, but together with the UFOs, you may add additional tools or additional rules to make sure that your trades are the highest probability as possible and provide the greatest advantage in exchange for the least of the disadvantage. Okay, so I will not comment further on that in today's session because my goal is to get deeper into options. But obviously, this is key because if you trade options, which are amazing, and I believe that all of you realize that if you didn't know it before, but if you were to buy the options or sell the options at the wrong time, well, even though options are amazing, you get in trouble. Okay, you get in trouble, and therefore, the idea here is to be precise with the entry and the exit of your trade, what is commonly known as well as market timing. Okay, that refers to the trading strategy. Okay, and this is always an answer that we need to give. You plan an options trade, and now you have to decide when do I get in, when do I get out. Okay, but again, that's for all trades. The second one, which is the option strategy. Okay, we up to this point we have covered two option strategies. Strategy number one, buy a call. Strategy number two, buy a put. Those are the two strategies that we have covered up to this point. So why do we call them strategies? Well, that's how it's known in the industry. Okay, an option strategy defines how to profit more efficiently from a given market setup. In other words, it refers to how do we combine options together to end up with a specific market edge. Options could be traded on their own. For example, you buy a call or you buy a put. But as you are about to learn today, options can also be combined together and end up with very fancy combinations that we call option strategies that produce a series of benefits that I would like you to explore. And let me tell you that what is known as options spreads, which is another way to say a combination of options, which are located at a different price point. That's why there is a spread. That's why it's called an option spread. So these combinations of two options at a time, it's likely, very likely, listen carefully, very likely going to be your bread and butter. And from now on, the majority of your option trades will be spread much more often than buying calls or buying puts on their own. It's not wrong to do that, but it will be more powerful for you in most cases to do more advanced option strategies as you are about to learn as we go, okay? But no matter the option strategy you're about to use, now we have the other two questions that we always need to answer. Okay, remember when we trade options, we need to answer two questions. Question number one, when to get in, when to get out. Question number two, what option strategy are you going to use? Are you going to buy a call? Are you going to buy a put? Are you going to buy a spread? Are you going to sell a spread? Even if you don't know what's a spread, it's okay, bear with me. That's the option strategy. But once you have decided the option strategy to be used, then we have those two additional questions, which question number one would now be, which expiration date are you going to use to buy this call or buy that spread or sell the call or sell the spread? And what is the strike price that you're going to use to buy the call or sell the call or buy the spread or sell the spread, right? So we always need to, if I ask you the question, which option are you going to trade? Okay, well, which option cannot be answered with one word? It needs to be two words. One is the expiration month or week. Second is the strike price of the option you have selected. Okay, so in the prior sessions, I'm just giving you a little bit of a wrap-up summary of things that we covered already. So again, we are focused on what we're going to do today because today is more advanced. So what we have covered up to this point is to buy a call or buy a put, and we have learned to calculate something known as the TTT, which stands for time to target, which is a calculation that basically tries to anticipate how much time it will take for you to get to expiration. Okay, and then to mitigate option decay problems, which is what happens when you buy options. Okay, we were suggesting to use the expiration date that lines up with the earnings reports, because the expiration date that lines up with the earnings reports normally receives a lot of demand for those options, and therefore typically as the expiration date approaches, those options start gaining value, because when people buy a lot of the options, in this case because of the earnings report is lining up with the expiration date, when someone buys a lot of something, whatever that is, including options, price goes up. So on one hand, you would suffer time decay, because from today until the earnings day, it may take 2 months or 3. So every day that passes, options decay. That's bad. That's a problem. But in the other hand, because of the earnings report, those options will tend to gain value as the earnings report date approaches. And therefore, you kind of offset the problem. And then on top of that, you'll have something that we'll need to cover someday in the future called gamma, that is going to help your trade even better. Okay, so we'll get more advanced as we're ready for it. Okay, but today, instead of getting deeper into rules and being even more precise with the rules, what I would like to do is to introduce you to the world of spread trading, option spread trading. That would be my goal, because the moment you are properly introduced to the world of trading option spreads, now you will understand why many times I say options give you options, and you will understand the flexibility aspect of options trading. And from there, we can get deeper into the Greeks, deeper into understanding how options are priced in the real world, not the way it's explained in most books, and therefore come up with additional rules to make our trading the most efficient as possible. In other words, to create as powerful as possible as a market edge using options that then combine with the beautiful UFOs on the right. Now you got the timing with the efficiency of the option strategy all put together, and now you kill it. Okay. Well, in case you haven't noticed, I love options. Well, probably since you are joining me on Sunday, probably you too. Okay, or you are realizing the power and you are about to love options. Okay. Anyway, let me take a look at your comments here. Yeah, Devan, it's a pleasure to see you, my friend. It's a pleasure. I believe it's the first time that you are joining us in the session here. So welcome. Yeah, the UFOs. I mean, let me give you a quick intro to what UFOs are, because I know that there are a few of you that are connected live with us, which is the first time that you're joining us, or some of you, I know you have emailed us to let us know that you'll be watching it recorded. But again, not everybody has been exposed to UFOs. So basically, what UFOs is an app that runs on TradeStation that identify on-field orders. On-field orders, the acronym for on-field order is UFO. So when the UFO, which by the way, it looks like a flying saucer, in other words, it looks like a UFO, and the reason why it looks like a flying saucer is because the algo running behind the scenes is identifying the areas where we anticipate the greatest concentration of on-field orders to be, and that is plotted in this shape of an inner circle within the circle, right? So anywhere within the outer circle or the rectangle, which is the same thing, you are likely to find on-field orders. When it's green is to buy, when it's red is to sell. But when you get to the little round circle within the circle, like the flying saucer, if you wish, so now you are hitting what would be expected to be the biggest pile of on-field orders available within that price region. Okay, and we call it UFO, because it's kind of fun. It's easy to say. We all understand what it means. The moment you understand what it means, it's short to say, and at the same time, really visually on our screen, it looks like little UFOs, isn't it? So that's why we call it UFO. But the beauty of this is that this is a technique that you could use to time your trades, to identify when to get in and identify when to get out. Okay, and on top of that, the beauty of the UFOs is that you could combine it with any other technique that you may want to use, right? So maybe you're a person who is a fan of Elliott wave theory. which obviously has a lot of, a lot of thought put into it by, very smart people that sometime in the past have come up with a theory out of observation and so on. And it's not only about the theory itself; it's about the fact that in present times you got computers programmed to trade based on what the theory of Elliott waves suggests, and therefore it may become a self-fulfilling prophecy because it was studied, but then people execute, or computers should I say, execute based on what the theory is. And if those computers happen to belong to institutions, those computers got the power to move the market based on the theory, and therefore the theory works. But same happens if instead of Elliott wave, you talk about any other market theory. Could be FIBs, could be moving averages, could be certain type of indicators, or Bollinger Bands, or projections, or run numbers in a chart, or you name it, right? And the beauty is that whatever your trading technique is, you now add the UFOs on top of your trading technique, and now you have a double confirmation. And that double confirmation, which is the UFO, is actually, in my mind, the most important confirmation, because even let's go back to Elliott wave theory, for example, just to pick one. Okay, and there are many market theories, but even though, let's say, Elliott wave makes sense, well, if you didn't have on-field orders when Elliott wave suggests something's going to happen, then nothing's going to happen, because you don't have the on-field orders. Okay, remember the mechanics of price movement is when orders get filled. So, the extreme is when the market is closed, right? When the market is closed, no orders get filled, so there is no movement. When the market opens, orders get filled, so now there is market movement. So why are the orders there in the first place? We don't know. Maybe it's because of FIBs, maybe it's because of Elliott wave, maybe it's GAN theory, you name it. There are so many theories in the market, technical analysis, whatever. So fundamental analysis too. So maybe that's why the orders are there. But the fact is that if the orders are not there, you got no price movement. So what the app is doing is finding the orders that are not filled yet, the on-field orders, UFOs, right? And this can be used by itself or can be combined with anything, right? And again, the purpose of this tool is to give an answer to the first question, which is when to get in and when to get out, okay? And by the way, I'm going to add one more, because in the world of options trading, okay, because options give you options, okay? So when used with options, the trading strategy also implies to be directional or to be non-directional. Something that we're going to start learning to do today. How to be non-directional, how to profit when the market doesn't really go anywhere, okay? What is very well understood by most traders around the world is how to get long, how to get short, how to profit when the market goes up, how to profit when the market goes down. But what about if the market stays in a range? Okay, well, this in options trading is called non-directional trading, and there are ways to profit from that, where if you were to trade any other asset but options, you cannot profit from a market that goes nowhere. The market has to move. Okay, so the UFOs can be used to either identify the direction of the likely direction for price movement, when the movement will start and when the movement will stop. That's your UFOs, that's your on-field orders, that's your timing, when to get in, when to get out. But if you choose to be non-directional, the UFOs will tell you where is that market likely to remain. So for example, I guess we all understand by looking at the chart that, for the market to reach the yellow circle, it would need to travel a long distance and hit that UFO, which is likely to push it down. And if it doesn't push it down, hit that UFO, which is even more likely to push it down. And both of those UFOs are likely to push it down. And if in the end it goes up, well, it may reach the yellow circle, but it's going to take a lot of time, right? And same happens below those green UFOs, or the one below even more. So for price to get all the way in the bottom part of the chart, it's going to take a lot of time just because of a pure distance to travel. But on top of that, when it gets to this UFO, it's likely to bounce to the upside. When it gets to that UFO, it's likely to bounce to the outside. So could you in the end reach the yellow circle in the very bottom of my screen? Of course you could. Okay, of course you could. But it's not likely to happen in a short period of time. So how could you do non-directional trading? So you could sell options, get paid, because when you sell options, you collect premium. Just like when you buy options, you pay premium. Well, when you sell options, you collect premium. And because options have an expiration date, now you just wait until that expiration date. And as long as that stock didn't surpass the red UFOs or surpass the green UFOs, next thing you know, you made money on collecting premium and waiting for time to pass until the expiration date, while you didn't care where the stock was going. You only cared about the stock remaining within UFOs, right? So that's non-directional trading. And this could also be called your trading strategy, if you wish, because it has to do with the timing. Okay, it has to do with the timing. So when to get in and when to get out. Okay. So anyway, we'll be putting all of this together, in a very structured manner. We'll end up with a beautiful kind of like list with bullet points, a beautiful table where everything is very well organized. This of course is going to take us a few more sessions, but we'll get to a point where all the options knowledge you need to get is going to be very, very clear. Okay. Let me take a look at more questions I have here before I begin with the spreads. So I got Devan. If you have proper delta at least 33 plus, plus or negative, gamma requirement will be satisfied. Yes and no, depending on what you are trying to accomplish in this particular trade. Okay, Devan, I get your point, and I would say that many cases the answer 100% agree with you, but there would also be times where it's not exactly the case, because maybe you are in a trade where what you're trying to do maybe some sort of a hedge, or maybe you are doing a trade to try to profit from something else, for example, rising of interest rates or things like that. So again, there are very advanced application of options that may not imply that what you said is exactly 100% correct. Okay, even though what you said makes a lot of sense for many trades. Okay, so definitely you know what you're talking about. So well done there with that comment, but we'll get a little more specific at times. Okay. I have also Orlando with a question here. So ES shows a doji bullish on the daily and an engulfing candle bearish on the weekly. What do we do there? What do we do here? The answer, Orlando, is first of all, your question is not an options question. So I'll answer very quickly, and maybe we can talk about it in an email or something like that, since I don't want to divert too much from the option subject today. But in any case, the answer to your question is you should do what your trading plan suggests to do, right? So if your trading plan tells you to trade when there is a doji, then you take the trade. If your plan tells you to trade when there is an engulfing candle, then you take the trade on the other direction. If your plan has to do with UFOs and moving averages and you don't care about the shape of the candles, then no need to overthink. So it's all about having rules and implement the rules. Does that make sense? Yeah, and Orlando, it's great that you ask. It's just that I also need to stay focused, because I think you know me, Orlando, and this would apply to many of you as well. If you ask me, I love this subject, guys. Okay, so you can really take me very far away, diverting from the subject, because I want to give you a very good answer, because I love the subject, and next thing you know, I come back too late to the subject. Okay, so that's why I was respectfully suggesting, and again, you know me, that we can talk about it, in a different day. But bottom line, it depends on your rules. Does that make sense? If you don't have any rules concerning candle formation, so forget about it. Does that make sense? I have a question here from D. Hyde. Here we go. So let me show the question on the stream. So D. Hyde says, I would think about offering that 2-minute explanation of UFOs at every session. Very good for new folks and very good for reinforcement. Excellent. Well, thank you so much. Thank you so much as well. It's funny that you made this comment, because I just commented out of Orlando's question that sometimes I may divert and get too deep into a subject, and it seems that your point is that sometimes I don't get enough into certain subjects. So I'm taking note from both of you, because sometimes I kind of assume that everybody knows what the UFOs are, and I totally get your point, and very, very valid comment, D. Hyde. Thanks for that. Okay. Yep. Okay, cool. So it seems that we are now in sync with all the comments, questions, etc. that you guys were asking, and it's now time to begin talking about option spreads. Okay, so to talk about option spreads, what I'm going to do is I'm just going to find a blank page here. So I want to be able to start typing stuff. Okay. And as you can see, as we're doing those sharpening sessions, the way I'm teaching you stuff, guys, is like I don't know how to call it. It's like you are my nephew. We are sitting at home next to each other. We grab a piece of paper and we start teaching you. Does that make sense? And I think that somehow, of course, we could come up with a much more visual, elegant way on how to deliver some sort of a content. But given the fact that all of you guys are UFO users, trading stuff and so on, I believe that probably it clicks to a deeper level to do it like that. Okay, and know that at some point you'll have available as well certain libraries of content that is already pre-formatted for you to also consult. Okay, but if that's okay, in these initial phases of sharpening sessions altogether, I'll be as creative as just using this blank page and just type and go over certain explanations as we are together in those sessions. Okay, I think hopefully you appreciate that. Okay, and again, of course, I'll be very, very open to any comment that you may have. Okay, because my ultimate goal is to help you guys. Okay, so option spreads. Okay, so what they are? Well, option spreads is when you combine two options contracts, okay, which, just to talk a little bit about terminology, we're going to call it 2 units. Okay, you combine 2 units, or 2 options contracts. You combine 2 units at the same time. Okay, could be buy 2 options at the same time. It could be sell 2 options at the same time, or it could be buy and sell options at the same time. 2 at a time. I don't know if this is helpful or I'm driving you crazy. But basically, when we talk about option spreads, what I want to make sure that you will understand is that we're using 2 options. Okay, 2 options means either 2 calls or either 2 puts or 1 call and 1 put. So that's why we call it 2 units. Because if I said 2 units, it means it's going to be 2 calls or 2 puts or 1 call and 1 put. And then what you do to those calls and those puts is you either buy a call and sell a call, or you either sell a put and buy a put, or you either buy a call and buy a put, okay, or you sell a put and you sell a call, right? So all combinations are possible, and it's 2 at a time, okay? And to make it more fun, okay, you could use the same expiration date to do so, or you could use different expiration dates when building spreads. Let me phrase it, and as we start building examples, all of these will click, because I realize right now that we have a long paragraph in front of us with no example, and this could be slightly confusing. Okay, just bear with me. Let me say it, and then as we go over examples, you'll see how all of these will click. I'll come back at the end of the session, reread these together, and you'll see how everything made sense. So you could use the same expiration date to do so, or you could use different expiration dates when building the spreads. What does that mean? Well, remember we said you could buy a call and sell a call, for example. That's what we said. Well, you could do that using the same expiration date. So, for example, you buy a March call and you sell a March call. But you can also use different expiration dates. For example, you buy a June call and you sell the March call. Right? So now you are combining two different calls that expire in 2 different dates. You could do the same with the puts. You buy a put and you sell a put. Okay, they could both belong to the same expiration date. For example, you buy a put that expires in March and you sell a put that expires in March. You could do that. Or use 2 different expiration dates. Buy a put that expires in June and sell a put that expires in March. You could do it too, right? And etc. So the sky is the limit, okay? And this is one thing that I want to make sure you all understand, okay? Let me ask you this question, guys, and please give me an answer in the comments box. Anyone in here in the group has ever bought and read a book on how to trade options? Anyone has ever bought or downloaded a PDF file from the internet or something like that, with option strategies? Anyone has ever done that by any chance? And here's why I'm asking. Because if you have done that, probably that book was quite thick. And if you open that book and you look at it carefully, probably you had many option strategies built in. I've seen books with 250, 400 option strategies. I've seen that in the market, right? And let's face it, first of all, as a trader, you cannot master 400 option strategies. You cannot get good at 400 strategies. That's just impossible. It's beyond being human. Does that make sense? It takes a lot of time and effort to put it in a book, but then it remains in the book. That's it. A different story is to have it embedded in your mind in a way where it became second nature. Well, I would say it's impossible to master 400 strategies. I mean, at least I personally could not do that. Okay, maybe there is some superhuman out there that could do it, but I believe that the majority of people, it's too much. Okay, now why are those books producing so many option strategies? Well, there are two reasons. Reason number one, because you can see just by the paragraph I just wrote, you can see that you could combine options in so many ways that if every combination you were to give it a name, oh my God, how many option strategies could you come up with? Is that making sense? And this is, by the way, this is only just by combining 2 options at a time. But what if you combine 3 options at a time? What if you combine 4 options at a time? So really, the sky is the limit, and that's why there are so many strategies. So reason number one why there are so many option strategies out there is because you could do so many different combinations. So my goal is to, of course, have you develop a proper understanding of those combinations, but focus on the combinations that are easier to implement, that require less of your time, that make you suffer less slippage, that are more efficient, that are easier to learn, that are safer, that require less buying power. So the idea is to be smart. The idea is to be efficient instead of just learning 400 strategies and then you get paralyzed in front of that book. Does that make sense? So reason number one why there are so many strategies in those books is because of that. Reason number two is because many often those books are written by people paid by brokers. And how do brokers make money? And of course, we need brokers, and we love brokers. But how do brokers make money? They make money on commissions. So what happens if you do an option strategy with 4 units? Okay, for example, 2 calls and 2 puts together at the same time for 1 trade. So what happens? Well, the broker would charge you 4 commissions instead of 1 or 2. Right? So those books, they will teach you the basics, but at the same time, there will be times where they teach you option strategies that are very complex. And complex doesn't mean difficult to understand. Complex means many units. And many units is very good for the broker, but not necessarily to you as an options trader, because you made your trade very complicated. You just opened the door for more possibilities for mistakes. You are paying more commissions per trade. You suffer more slippage because you got more units. So you start at a disadvantage instead of starting at an advantage. Okay, so again, as we go over option spreads and more fancy strategies, I will always keep in the back of my mind this efficiency concept I'm sharing with you, where the idea would be to discover options trading and have a proper, like really proper understanding of how options trading work, but not necessarily fall into the trap of doing what's too complex, too complicated, because now you work for the broker instead of working for you. I would like to find a balance between using a little complexity if needed, in the sense that because it produces an advantage, okay, but never cross the line and go for complexity if you don't have an advantage. Does that make sense? So long story short, spreads is a strategy that you will use very often because it's only 2 units at a time. Okay, so that keeps it quite simple. I mean, it's more complex than using 1 call or 1 put only, but it will produce certain advantages, as you are about to see, that will make it really worth it. Okay, really worth it, and it's still very simple. Okay, so that's the goal. Mario, very good question here, Mario. Very good question. So which is an acceptable number of strategies that can be mastered? Okay. Look, a bunch of them. To be honest, to give you an answer with a figure, I need to just to spend a few seconds counting strategies in my head to be able to give you an answer, which I'm going to do right now. But before I do this count on my head, because I never thought about it this way, here's the good news, Mario, and everybody. The rules that we're going to be learning on how to on how to put together options trades, the rules will apply. I mean, there will be rules that apply to all the strategies, no matter the strategy. So mastering multiple option strategies will imply mastering a set of rules, which are basic rules, like, kind of like your bread and butter type of rules that you do all the time. And then for certain other option strategies, we may add a couple more rules on top of it, just because those strategies have some implications that we need to manage via a couple more rules. Is that making sense? So in other words, you will be able to manage multiple option strategies, even though I just said before that there is so many that we could manage, but you will be able to manage a bunch of them at a pretty. You will be able to learn that at a pretty fast pace, because in the end, the rules that are your bread and butter for options will be the same no matter the strategy. Okay, so now how many are they? So let me count on my head. So we're gonna have buying options. Okay, buying a call, buying a put. That's one. Selling options, selling a call, selling a put. That's strategy number two. Then we'll have debit spreads and credit spreads. So doing spreads for a debit, doing spreads for a credit. That's going to be strategy 3 and 4. Then we'll have option strategies with 3 legs, 3 units. And those are going to be the ratio spreads. Okay, so now we're talking about 5 option strategies. Then we'll get into the world of butterflies and iron butterflies, which are 4 units, and then we'll get in the world of iron condors and double diagonals, which are 4 units at a time as well. So if I counted well, I'm talking about 7 strategies, 7 option strategies that it's certainly doable for you to master 7 strategies. And of course, you will have versions of them, because you will have, for example, you will have the spreads that could be directional or non-directional. And if they are non-directional, they are non-directional, but if they're directional, they can be bullish or bearish. So out of every one of those 7 strategies, you can find up to 3 scenarios, which is bullish, bearish, non-directional. So 7 times 3, 21. That's the number. Okay? And again, it's way easier than what it looks like. Okay, if I tell you, I'm going to teach you 21 option strategies, you're going to be like, oh my God. Well, you'll see how in the end, as long as you master the basic rules, everything falls in its place. Okay, so very good question, Mario. Very good question. Let me see. Yeah, cool. Yeah, very good. So now, so what is a spread? Okay, so what is a spread? Okay, so why do we combine options? Okay, why do we combine options? Okay, well, a spread is when you combine two units together. So why do we combine them? Okay. Well, here's why we combine options. And if I look at SQ here and I activate the implied volatility stochastics indicator that comes with TradeStation by default. Okay, if I activate that guy and I end up with this particular line in the bottom part of my screen. So what is this indicator showing you? Well, what that indicator is showing you, that indicator is basically is becoming like purple color on the top and bluish color or greenish color on the bottom. And what that means is that the higher it goes, the more overpriced options were, and the lower it goes, the cheaper and the more underpriced options were. Okay, in other words, options are known as a derivative instrument. Okay, and for you to understand the why we use spreads, I need to very quickly come back to something that we discussed briefly in the past, which is how options are priced. So I need to rephrase a couple of things. So we said options are a derivative asset. What does that mean? Well, they derive their value from the underlying asset. Okay, there is an underlying asset. In this case, we are looking at the stock SQ. You can see the stock symbol right here, right? We're looking at the stock SQ, and the stock SQ have options available every single day when the market is open. You could trade them, but guess what? Those options, they do derive their value from the price of the asset. In other words, if that asset moves up, the price of the options will go up. Okay, they derive the value from the underlying asset. But not only because of that. Okay, there are other factors. Okay, there are other factors impacting the options price as we discussed in the past. And here, for example, I would like to activate another TradeStation indicator. Actually, it's not an indicator, it's what TradeStation calls a show me. And I would like to activate the EPS postings, which basically it's an indicator that is going to show you when is it that we had earnings reports, when is it that the earnings per share were posted for that stock. And when I do that, okay, you can see here, for example, with a vertical line, there is a red dot, okay? You can see that right before the earnings, options were up and then they dropped in value. You can see that the next earning report was 3 months before, right there with the vertical line. You can see that right before the earnings, the options were overpriced and then they lost value. You can also see at that moment in time, okay, that that was the other earnings report, that right before the earnings report, the options were overpriced and then they lost value. So what the indicator having the bottom is calculating is, how overpriced those options were by looking at what the theoretical or fair value of those options should be, given the price of the stock, the time to expiration, etc., 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 and contrast that information with the real price of the option that day when you look at it in the option chain real time. And basically, if the option is more expensive than what it should be, then this indicator is identifying something known as the implied volatility of the option. In other words, how much volatility is implied within the price of the option. In other words, how much the options traders that buy those options and sell those options expect the stock to move in the future, right? Because the volatility is implied, is not volatility that happened already, is volatility that may happen in the future based on the expectation. And people buy based on the expectation. They buy before the fact, isn't it? Or sell before the fact, and therefore that implied volatility calculation, which is being run by our computer, is telling us that level of how that level that represents how overpriced those options are or have been in the past, or how underpriced. Notice how there was a moment in time where options were very, very, very cheap. Okay, and by the way, that's why we buy. Remember when I talked about the rules for buying options, right? And we say, hey, use the expiration dates around the day where the earnings were reported for that stock. Why? Because as the earnings approach, this is what will typically happen to the price of the option. It goes up. Okay, so you lose on time decay, but then you experience that growth of value in the value of the option, and that offsets the problem. But anyway, so why, coming back to the question, so why do we use spreads? Okay, why do we combine options? Okay, well, because in a perfect world, if everything was perfect, right, and this is, let's say, the midpoint, okay, let's say I'm just going to make it a dark green color. Let's say the dark green colored line represents the fair value for the option, the ideal value, the value it should be in a perfect world. Well, notice that, the value of the options in the real world differed greatly from the theoretical fair value calculation I just came up with. There were times in the life of the options where they were very underpriced. There were times in the life of the options where they were very overpriced, and there were times in the life of the option where options were, more or less, fairly priced, more or less fairly priced. But options are not fairly priced all the time. I would actually suggest that most of the times you are not going to have a fairly priced situation. Okay, normally you will always have a little bit of a bias, underpriced or overpriced. Okay, and how do you manage that? Because think about it. Let's say you didn't want to combine options, and you decided, look, I'm very positive because I got 2 green UFOs on top of each other. The trend is up. The stock is outperforming the market. Everything is beautiful. And, I'm very, very positive based on my trading plan that stock is going to go up. So I want to buy a call. Okay, let's say you want to do that and you have a very strong opinion about it, and basically it's not only your opinion, it's actually the rules of your plan. And let's say you're even right and it's gonna go up and it's an amazing trade. Okay. Well, what if that happened at this time? Okay, and you bought at that time, okay, which is when the options, okay, the options were here super expensive, super overpriced. You were actually right that the stock you thought would go up, and then you would want to buy a call to profit from the movement to the outside, and you were right. But notice what happened. While you were right and the stock was moving up, and you were gaining some value because options derive their value from the underlying asset, well, while that was happening, okay, behind the scenes, the overpricing effect of the options became underpricing effect. So let's say you have taken profits on that day, for example, okay, you would have made a profit for sure. You would have made a profit because you bought here and you sold there. So, you went from circle to circle as the arrow is pointing. So you made that size of a profit, okay? Kind of like from, up to 74 something, and the beginning was like 50. So you made like $24 in this trade. That was an amazing trade. But even though you made $24 in the trade, I am telling you that when you sold the call you bought and you collected your profit, you would probably be very disappointed because you thought you made 24, and I'm just going to make this up, and maybe you made 16. Okay, and why did you miss on that part of the profit right here on the top? Why did you miss on that part of the profit? Well, because while you were in the trade, the options lost value, and the reason why that happened is because when you bought them, they were overpriced. Okay, they were overpriced. So to be technical, the intrinsic value portion of the option moved in your direction, but the extrinsic value portion of the option moved against you. So it's kind of like you have this car with a very powerful engine, and it's very nice to hit the throttle because you can feel the horsepower kick in. But someone put a parachute in the back of the car, and the faster the speed you try to get with the car, the more powerfully the parachute is trying to stop the car, and you have this fight with the horsepower and the parachute. So yeah, the car still is moving, but it's not moving at the pace you want it. Okay, and that would be the problem if you were to buy options on their own in a situation like that, and that is why we combine options together. So if instead of buying a call, I had done buy a call and sell a call, okay, of course with different strikes. If I use the same strike and I buy the call and sell the call, then I bought the call and then I sold it, so I got nothing, right? I'm flat. But if you buy, for example, the call here, so here we got 50, and here we got, again, let's talk about 74. Let's say those options existed, and you have done buy the 50 call and sell the 74 call. So now you're going to have an offsetting effect because you bought overpriced. You bought overpriced. Okay, the 50 call you bought was overpriced. Okay, but you sold an overpriced option too. So what's going to happen? If the options get more overpriced, if the options get even more overpriced, so what's going to happen is that the 50 call you bought gains value, extra value, because it became more overpriced, okay? And the 74 call you sold also gains extra value, okay? And, it kind of offset each other, okay? So you have an offsetting effect. is like when you bought the option, they were not overpriced because, when they gain more price, you didn't experience anything. You're kind of flattening or limiting the effect of this phenomenon of having the price of the options to shrink. You are minimizing that phenomenon to hurt you because you sold an option against the option you bought. If the options become underpriced, the option loses value. Underpriced. Okay. So then the one you bought would lose value. Okay. That one loses value. That's bad. It's hurting you. That's what I said before. It's like you have the engine trying to push, but you also have the parachute stopping you. Okay. So that's bad. But the other one also loses value. Okay. And what happens when you sell an option? When you sell an option, do you want it to lose value or do you want it to gain value? Well, you want it to lose value. Why? Because if you sold an option for 5 and the option dropped from 5 to 2, then you can buy back the option at 2 and you made $3 because the value of the option you sold went down from 5 to 2. In other words, if you only bought the call and now the options become underpriced and your call loses value, that would hurt you. But because you sold a call against the call you bought, and now the options became underpriced and therefore the call you sold lost value. So another way to say that is that the call you sold is making an extra profit for you while the call you bought is losing a little for you. So the little you're losing together with the extra profit you made on the call you sold is creating again an offsetting effect. And somehow you are neutralizing the fact that the prices of the option, okay, sometimes they will raise in value, sometimes they will drop in value, sometimes they will do not much, sometimes they will drop in value, sometimes they will raise in value, etc., etc. You're kind of neutralizing that problem. You are removing that variable or unknown variable out of the equation, and therefore you're making your trading much more consistent and more on the safe side. And that's one key reason. Okay, that is one key reason for you to do spreads, for you to combine options. But there are more. Okay, there are more. For example, the fact that you would also lower the cost of the trade and therefore the margin requirement. For example, if you only buy the 50 call, and let's say the 50 call, cost you, $7, right? Well, $7 times 100, which is the amount of shares built in an options contract, that would cost you $700. And therefore, for you to be able to take the trade, you would need $700. But what if you do the spread? Well, you do $700 when you buy the 50 call, but now you sell the 74. Let's say the 74 is trading at $300. If the 74 is trading at $300, well, what's going to happen is that you're going to pay $700 and you're going to collect $300. So what's the net cost? What is $400? So now you only need $400 to be in the trade instead of $700. Now, of course, and we'll get deep into that, some of you are thinking, wait a minute, you also have less delta. Okay, you also have less delta. Okay, remember delta? We talked about this in the last session, guys. Actually, 2 sessions ago. Okay, delta is one of the Greeks. So here's the delta, right? Okay, theoretically, it means the probability of having an option expire in the money. That's what it means theoretically. Okay, but that's not exactly how we look at it, isn't it? The way we look at delta, okay, the way we look at delta is a little more practical. That we talked about this the other day, very briefly, 2 weeks ago, if I'm not mistaken, when we were learning how to buy a call. So delta is a measurement of speed of profitability. Okay? Speed of profitability or loss. Okay? In other words, how fast you profit if the stock moves your way, how fast you lose if the stock moves against you. Okay, that's what delta is. So if you have a delta of 30, okay, it means if the stock moves $1 in your way, you make $30. If you have a delta of 50 and the stock moves against you by $1, it means that you're going to lose $50. Why? Because delta is 50. So $1 against you times 50 equals $50 loss. Okay, so delta is a measurement of the speed of profitability given a $1 move, okay, on the underlying. Okay. Again, sometime in the future is not super urgent, but sometime in the future we'll have to do proper sessions on the Greeks to understand this to a much, much deeper level. Okay, but for now, I would say it's good enough. So let's go back to what we were typing here. So let's say buying a call. Okay, let's say buying a call. Yeah, it's gonna cost you 700, but it's gonna give you 50 delta positive. Okay, 50 delta positive. Well, if it's gonna give you 50 delta positive, it means that out of a $1 move on the stock in your direction, you're gonna make $50. That's the speed of profitability. Now, what if you sell an option and the option you sold got a delta of 15? Okay, well that means, okay, that means that if the stock moves in your favor, because the delta is negative, you will lose $15 per dollar movement. So your net profit would not be 50, would be 50 minus 15, which is 35. And you may say, wait a minute. Yes, it's true. Jose was right. Instead of $700, I only need $400 in my account. So I can do the trade with less money, but instead of being paid at a rate of 50, I get paid at a rate of 35. And again, I'm just making up the figures here. But think about it. What about you do two spreads? If you do two spreads, okay, if you compare two spreads against the guy on the left, right? So if you do two spreads, you're gonna have to pay 400 times 2. That's 800. Now 800 is basically the same as the guy on the left, right? The guy who bought the call by itself, right? But what happens now? Well, instead of 35, you're gonna get 35 times 2. Why? Because you did 2. So what happens? You got 70 delta. You got 70 delta. So now just by using $100 more, okay, you got like 40% more performance on the trade. Okay, so spreads, I am telling you guys, and you will see that very quickly, it's gonna be your bread and butter. It's powerful stuff. Okay, powerful stuff. But anyway, so why do we use options? Well, we said it before. Number one, because we have an offsetting effect. Offsetting effect allowing us to, I'm just gonna write it in a way that is not correct, but you will get me. Allowing us to ignore, under pricing / over pricing scenarios. Okay, so you basically don't care anymore if the options are inflated or deflated, cheap, expensive, overpriced, underpriced. You can just do spreads and know that more or less you are okay. Where if you were to buy calls or puts by themselves, you know you are taking a major risk that sometimes you may be lucky. Okay, sometimes you may be lucky and you buy options, you buy calls when they are super underpriced, and then all of this happen and you catch the move and you just kill it. Okay, but what if you bought those options somewhere in the middle and then they went down? Okay, now you got hurt. So if you want to kind of offset, that's the word. Okay, if you want to offset that problem, that's one of the reasons to do spreads. And the other reason is to reduce buying power of our trades. Okay, so we become more efficient. Okay, there is one more relevant aspect that applies to selling options, okay, or credit spreads. Okay, let me explain that in a minute. But before I explain that, I want to take one of your questions here that is waiting. Actually, there are a couple of questions there, and also I would like to ask you guys to report to me on the comments box, guys, with a quick message to let me know that you're following, or if I'm going too fast or something and I have lost you, please let me know how is it going on your side, guys, please. Okay. So Mario has a very good question here, and Mario says, okay, so Jose, but the 50 strike call should be expensive because it's deep in the money and high IV. Well, again, this is where we'll have to get a little. I get your point, Mario, but this is where we'll have to get a little more precise with options terminology, and of course, in this case, it's my bad because there are certain things I haven't explained yet. Okay, because I would like to do that just a little later in this presentation. I think it would be more adequate at some point later in time. But basically, the term of expensive options, okay, let me put it this way, options traders or traders in general, we don't use the word expensive or cheap. And I know I used it earlier because I was just using plain English to do an explanation. But if you get purist, we don't use the word expensive or cheap, because expensive or cheap is a subjective condition for price. And what we will want to do is to have an objective condition for price instead of a subjective condition for price, right? And that's going to be what will really add an edge in your trading, right? It's not about how you feel about the trade or the fact that the 50 is more expensive because it's deeper in the money. Well, yeah, it may. What if the 50 is deeper in the money, but the time value portion of the option is less? So now you need a greater buying power, but you get a greater buying power for a greater amount of delta. So now you can use less options per trade. So yeah, that option using plain English was more expensive, but actually that option was cheaper than another option because you need less options for the same trade. So it's all relative, okay? And therefore, we'll need to get a little deeper into understanding options pricing to construct options trades in a way that they are optimal, so we reach the maximum performance as possible with the minimum use of capital and the minimum risk. Okay, so bear with me on that, Mario. I get your point, and but again, an option has two portions in its value. What is known as the intrinsic value and the extrinsic value, where the intrinsic value has to do with the real value based on the price of the stock. So if you buy the 50 call and the stock is trading at 51, you got $1 of intrinsic value. No one is going to take this away from you because it's intrinsic. Okay, but that 50 call, when the stock is trading at 51, that has $1 of intrinsic value, that 50 call is not the same price depending if you have 2 days to expiration or 2 months to expiration, right? That option is not the same price depending if you have earnings reports 2 days from now or earnings reports 2 months from now. So there are multiple aspects that impact the price of the options, and therefore cheap or expensive. Even though it's plain English, and I myself used the word earlier, we'll need to end up with a method. Basically, I'm talking about rules that I'm going to be providing you with, where you will measure that in an objective scenario where there is no subjectivity about what we feel cheap or expensive could be. Okay. So I know there is a little bit of an abstract aspect of my answer because there are certain things I haven't taught yet, so I cannot be more precise, but hopefully overall you got my point, and believe me, I will get there. I mean, I guess that all of you are realizing that those sessions are getting more advanced little by little, one step at a time, so I'll make sure everybody's on board. Okay, so we'll get, we're gonna get and touch the moon. Okay, guys, that's where we're going. We're gonna touch the moon and then come back home and say we touched the moon, right? So believe me, we're gonna We're gonna add a lot of stuff to make this very powerful, okay? Biodun, we have a question from Biodun here. How do you trade options in a 401k 457 account? Okay, well, I would say my initial answer to this question is you cannot. Okay, normally 401k and 457 accounts are accounts where you have many limitations. Typically, the majority of people using 401k, 457 accounts are only allowed to use mutual funds, sometimes if they're lucky, ETFs. But normally that's about it, okay? Now, could it be that some company in the US is providing a very fancy 401k plan that does allow for options? It could be, but I have never seen it before. So it's not like I'm super expert of 401ks either, because you probably know I reside in Singapore, which is the other side of the world, even though I have resided in the States as well, and therefore it's a little bit of my second country too. But I do not have a running 401k, and therefore it would be advisable that you talk to your human resources department. Probably they can answer this question better than me, but be ready, because the answer is extremely likely going to be you cannot. Okay, so if you wanted to trade options in a tax efficient environment, what I would suggest you to do is very simple. Just set up for yourself what is known in America as an IRA account. Okay, the R stands for retirement. And those accounts are tax efficient. You have tax deferred, and in those accounts you could actually trade not only options, you can trade forex and futures too. Okay, so and now instead of giving all your money to your employer and contribute to your 401k, you can just put your money into your IRA account and use options. Okay, but within the 401k you cannot. Subhash, we have a question from Subhash here. How are you, my friend? Following except the delta condition requirement, do we need to consider delta condition for spread? Yes, we do need, and I haven't given you the rules yet. So that's why you were not following there, because I haven't given you what's the minimum amount of delta we will want, okay? Earlier, Devan gave you a clue, okay? So Devan, you gave us all a clue earlier when you were shooting for 33 delta. We'll talk about that later, okay? But we're gonna be willing to shoot for a delta around that figure, okay? But we'll see. You'll see how we're gonna construct that. So what else? Look, up to this point, everything I have said apply to what we know as debit spreads. Sorry, guys, I had to take a sip of water. So everything that I have described applies to debit spreads. Okay, so let me write it down here. So debit spreads, okay, debit spreads, and move this to the right, like that. Here we go, pretty, very pretty. So this applies to debit spreads. So what is a debit spread compared to what is it if we call it a credit spread? So what's a debit spread and what's a credit spread? Well, remember, a spread is an option strategy where you combine two units. You buy a call and you sell a call, or you buy a put and you sell a put. Now, depending on the strike price increments, let me bring an option chain so you will see that very clearly in front of you. Okay. So Option Station Pro is going to be loading here. So depending on the strike price increments that you plan to use for the trade, you will end up with either a debit or a credit. And not only depends on the strike price increments, it also depends on out of the two options you're going to buy, out of the two options where one is bought and one is sold, it depends on which strike you bought and which strike you sold. For example, on the left, this is the option chain. We are looking at SQ. You can see that here on the upper left, isn't it? SQ. Also on the left, you can see there are calls. Okay, so let's begin with the call. So let's say I want to buy a call and I want to sell a call. Let's say that's going to be my plan. Okay, so buy I call and sell a call. Let's say that's what I'm planning to do. Okay. So let's say you plan to do that, and let's say selected that I am gonna buy the 71, okay, and I am gonna sell the 76. Okay. So if I buy the 71 and I sell the 76, right? So what does that mean? It means that I would be paying $4 to buy the 71 call. Remember, we're looking at the call side. Okay? And I would be being paid 82 cents for selling the 76 call. Okay, just to have easy math, let's say it's $1. So if you get paid one, okay, let's call it $1. Okay, if you get paid one when you sell the 76, and you have to pay 4 when you buy the 71, so you end up in a net debit, which is equal to 4 minus 1 equal $3 for the spread. Okay, so you buy the 71 call, you sell the 76 call, that would cost you $3. You would have to pay $3. Money would come out of your pocket, and therefore it's a debit. Okay, and that's why it's known as a debit spread. Now, what if instead of buying the 71 and selling the 76, what if you still look at the 76, okay, you still look at the 71, same strikes, okay, but instead of buy the 71, you don't buy the 71, you sell the 71. And instead of being paid 76 because you sold the 76, you don't sell the 76, you buy the 76. So now you are selling a call and buying a call, right? And what will happen? Well, the one you are buying would cost you $1, 96 cents. Out of simplicity, I'm going to call it $1. Okay. And the one that you are selling is going to pay you $3.90. Out of simplicity, I would call it $4. So what will happen if you do that? Well, what will happen if you do that is that you get a credit. Why do you get a credit? Why? Well, because you have been paid $4 and you had to pay $1. So you end up with a net credit of 3. The debit spread means that you paid 3, where the credit spread means that you have been paid 3. So debit means money comes out of your pocket. You are a net payer. Credit means money comes in your pocket. You are a net receiver. So you're doing two trades where one is buy, one is sell. But of course, depending on the strikes that you have selected, which in this case is 71 and 76, depending on the strikes that you have selected, you would end up with either a debit or a credit. And of course, this is not going to be just a coincidence. Let's do a spread and let's see what happens today. Is it going to be a credit or a debit? No, this is going to depend on your UFOs. Okay, because why would you use 71? Well, because there is a UFO there. Why would you use 76? Right? Well, you would use 76 because somewhere around 76 there will be a UFO too. Right? And therefore, depending on the bias of the trade, is it a directional trade? Is it a non-directional trade? Is it a trade where you are bullish? Is it a trade where you are bearish? So depending on what you are trying to accomplish, you will construct your spread for either a debit or a credit, where debit spread means money is paid, okay, and credit spread means money is received. Okay, money is received. So now, when money is received, there is a direct consequence. When you get paid something in life, the most you will make is whatever money you got paid. That's it, right? If you work as an employee, and you have been paid whatever amount of money as your paycheck, well, that's the most you will make. That money is not gonna grow like magic. When you get paid, whatever you got paid is what your profit will be. So when you do credit spreads, the most you will make is the credit received, and to collect this credit, you need to wait until the expiration date. It's very similar to if you were to work in the insurance business, okay, and you sell insurance policies. When you sell insurance policies, for example, you sell an insurance policy to a car driver. So what happens the moment you do that? You receive premium. As the insurance company, you receive premium. And what's the most you will make from that car driver? Well, the premium received is the most you will make. So again, in all scenarios when we get paid, could be trading, could be life, could be insurance. In all scenarios when we get paid, the most that we will make is whatever we have been paid. Okay? So keep that in mind. But what happened for you to be able to call that money yours with no extra liabilities? Well, for you to be able to call that money yours, you need to wait until the expiration date. When the insurance company sells an insurance policy to a car driver and collects premium in exchange for selling the insurance policy, that insurance policy knows that the most they will make is the premium, and for them to be able to know that there is no liability attached to the premium collected, they know they need to wait until the expiration date, because on the expiration date, that policy expires, and therefore there is no obligation or liabilities left for the insurance company. Exact same thing happens when you sell options. If you sell an option, you get paid premium, and in exchange for the premium received, you have certain liabilities. Okay, and I mean, the liabilities. Day one, if you sell options, you have an obligation to sell or an obligation to buy the asset, depending if it's a call or a put. So you acquire an obligation, just like the insurance company is obliged to fix the car if the car driver crashes the car. So the options trader, if you sell a call, you're obliged to sell an asset. Okay, if you sell a put, you're obliged to buy an asset. That's your liability. That's why you need buying power to be able to do these trades. You don't need much, but you need some money. Okay, you will not be allowed to sell options unless you have money in the account, which is common sense. So the moment you sell an option, you get premium, you have a liability, and now what happens for you to be able to call that premium yours? You need to wait until the expiration date. You need to wait until the expiration date. And what does that mean? It means that you make money as time passes. You don't care if the stock is going up or down. You just want time to pass. Of course, if the stock was to go too far, where you now need to fulfill your liability, well, now it's going to be painful. And the credit spreads will offset that problem, as you will see in a minute. Okay? But again, when you sell options, when you do credit trading, that's another way to say selling options. You do credit trading or credit strategies. The way you get paid is because time passes, right? And the stock either move your way if you have a directional bias, or the stock remains in a range. But time has to pass. That's how you get paid. Where when you do debit spreads, you pay for you to acquire the spread. You don't have liabilities. Okay? But you better have the stock to move, because if the stock doesn't move, then the spread will not change its value, and therefore you will lose. Why? Because the stock is not moving, or if the stock moves against you, you will lose. So when you do debit spreads, you profit by having the stock move your way. So debit spreads are directional. right? When you do credit spreads, money is received. Okay? So debit spreads, credit spreads are non-directional. Okay, non-directional. Even though we'll talk about little tweaks where you can do non-directional stuff with a directional bias. Okay, and just like I said, options can be very overpriced, very underpriced, somewhere in between, or a little bit in between but a little high, or a little bit in between, a little bit low. Okay, well, same thing's going to happen with the options that we're going to construct. We're going to be able to give more or less directional bias within being directional or within being non-directional. We're going to be able to tweak the directional bias. Again, options trading is amazing, my friends. It's so powerful, so elegant. You can do things so precise and so fine that you could not do with other assets. Okay, so it's very cool. Now, of course, there is more stuff that we need to discuss together to be able to do all of this properly. Okay, so in credit spreads, we are offsetting the effect of overpricing or underpricing. Again, why? Same story, because earlier I gave you the example of what if you bought the option, and after you bought the option, I think I was pointing at here, what if you bought the option and then the option lost so much value going from overpriced to underpriced? Well, then that would be painful. You were right on direction, okay, but you were wrong when it comes to the assessment of the price of the options, and therefore you got hurt. You still made a profit, but very disappointing one, right? But the opposite is true as well. What if you sold an option when the option is so cheap, okay? And of course, the day when you reach expiration date, the option will be zero in case the stock stays the same or stays in a range or goes your way. But what if you were in a non-directional and a little bit of a bullish bias, okay? Little bit of a bullish bias, okay? Non-directional, a little bit bullish, okay? And you sold the option, and now the option is gaining value. Well, this is bothering you because it's not good, right? When you sell options, you want them to lose value. So that's not good. But at the same time, you don't care too much because you're thinking, okay, it's fine, because I just need to be patient. When I get to the expiration date, the option is going to be zero anyway. Okay, so you would think that, but wait a minute. That is only true if the stock stays in some sort of a tight range. But what if the stock doesn't stay in a tight range and the stock starts trending heavily and really moves heavily against you and now surpasses those levels? Okay, surpasses those levels where now you are obliged to fulfill certain liabilities. Well, now you got a major loss. Does that make sense? So again, you need to have everything under control. The level of the price level of the option, is the option overpriced or underpriced? This needs to be kept under control. But not only that, the directional bias of the options. And here is when I need to add another important difference that that you guys need to understand. But before I do that, I want to double check questions and make sure everybody's with me. Orlando is being very, very kind. Orlando, I'm just gonna brag about your message, my friend. Thank you for that. You make me blush, but you make me happy. And a little Sunday humor. And Mario, should we always sell out of the money options? Well, not necessarily, Mario, not necessarily, because it depends on what you want to do. Let me divert just a little bit. Okay, let me divert just a little bit to answer your question, Mario. Okay, just because even though I'm diverting and I am aware I'm diverting and I need to go back to the credit spreads, but at the same time, I want you to think about options properly, and most people don't think about it the way I'm about to explain, and I want to make sure you develop the right mindset with options. So, and this has to be done in early stages. Okay, so think about this for a minute. Let's say you buy a stock. Okay, so plus means you're long. Let's say you buy a stock. Okay? And now you want the stock, but now your concern is like, okay, you know what? If the stock falls, I may end up with a loss, right? So you say, okay, you know what? What I want to do is, together with the stock I own, I'm just going to buy a put. Okay, so I want to buy the stock and buy the put, because the put, if you remember, it gives you the right to sell. So if you bought a stock, let's say you bought the stock when it was at 20, and the stock now went up all the way to 40, and now you buy the 40 put. Okay, well, let's say the stock drops. Okay, let's say the stock drops to 5. Doesn't matter the stock dropped to 5, because the 40 put gives you the right to sell the stock at 40. So you just bought the insurance for the stock you own. Okay, you have your stock position protected. Okay, so what's the most you can lose? Well, the maximum risk, okay, in a scenario like this, the max risk is the premium paid for the put. That's the maximum risk, right? If the stock drops to 5, you can still sell at 40, but if the put cost you $75, you had to pay 75. That's the premium paid for the put. So what's the maximum risk? The premium paid for the put, right? Well, if you all understand what I just said, you should understand that this is equal to buying a call. I buy the 40 call, right? What's the most I can lose? What I pay for the call. Correct? So what's the most I can lose? The premium paid for the call. Now, what if the stock goes up? You profit. You profit minus what you pay for the call. What if you're in the right scenario and the stock goes up? What's the most you can make? You will make whatever the stock makes as the stock moves up, minus what you pay for the put. And putting on the side that puts and calls have slightly different values, that often has to do with things like dividend payments and things like that, which are built in the price of the put and are not built in the price of the call. But when dividends, for example, are paid, the price of the stock goes down. So yeah, the put has more value, but when the stock goes down before the expiration of this put, right? Before the expiration of this put, when the dividends are reported, the stock will go down by the amount of extra premium the put got built in. In other words, doing the thing on the left would be exactly the same as just buying the call with nothing else, right? So very important formula for options traders is that buying a stock plus buying a put equal buying a call. Why am I saying that? Well, again, I'm halfway into answering Mario's question. So let's say you tell me, wait a minute, Jose, I'm an investor, and I read about a strategy called cover calls, where you buy a stock and you own it. Okay, you buy a stock and you own it, and then you go ahead and a few strikes above, you sell calls above the current price of the stock, right? That's a typical classical strategy, right? And that option above the price of the stock is, Mario, out of the money. So typically, most people would think when you sell options, they're out of the money. But if what I said above is true, which is it is, if buying a call equals buying the stock and buying the put, well then selling the call equals selling the stock and selling a put. Correct? So basic math here, and I'm not sure if all of you are fans of math, but if I take this out of the money call and I tell you that this is equivalent to shorting the stock at that price and selling at in the money put, right? And doing basic math, if you agree with me that this is the case, so I'm going to remove that. And when you do basic math, you remove the stock, and you remove the stock because plus stock minus stock equals 0. So basically, doing a cover call, okay, doing a cover call, which is buy the stock and sell the call, that is equivalent to selling puts which are in the money. In other words, we not always sell out of the money options. It could be absolutely fine to sell in the money options if what you're trying to do in this case is equivalent to a cover call strategy, which is a very good strategy for investors. Okay. Now, a cover call strategy is directional. Okay. It's not non-directional, it's directional. Okay. So you make money as the stock moves up. If the stock moves down, you lose money with a cover call. You also lose money selling puts. Okay. You guys okay with that? That was a little more advanced as an explanation, so hopefully you guys are following, and if not, go back and watch recorded, guys, okay? Because again, this is not directly related to the section today, but I just want to spice it up a little more for the most advanced traders in Rome. You know what? Let me give you one more tweak. Another strategy out there is, let me do this so you understand what I'm looking at. Okay, let me do this because I want to do it on this piece of paper here. So I'm working on the middle part, okay, on the white space. So so take a look at this. A typical strategy that is being used by many people, I just said, is cover calls. You sell a call because you want a stock because you bought at a lower price, and many people will say, okay, wait a minute, I just sold this call, so I got some premium. So let's go ahead and use that premium to buy puts below the stock. In other words, buy home insurance by using tenants payments. Okay, what am I saying here? Well, you sell calls against the house you own. So you own a house, you put tenants in the house, they pay you. So you use the payment from the tenants, which is the premium collected by selling calls, and you use that money to buy insurance, which is buying puts. And now you just ended up with what is known as a collar strategy. This is a collar. Okay, in options trading, everything got very fancy names. Please don't be intimidated by the names, but that's how it's called. So that's a collar. But wait a minute. If what we said is true, and buying the stock equals buying the call and selling the put, right? Because if what we said here at the beginning is true, okay, then I move this put to the other side, which is minus P. So buying the stock is plus call minus put, okay, and therefore I eliminate that, okay. So what do we have? The call and the call counteract each other, or the put and the put counteract each other, and basically, what did you end up with? The collar is equal to magic, drum roll, a debit spread, where you buy a call and you sell a call. Like for example, you buy the 50 call and you sell the 74 call. And so all those equivalencies that I'm talking about right now is just a little too soon for me to talk about it. But sometimes I like to just put it in front of you guys, even if maybe the explanation was just a little too advanced here for some of you, because I mean, out of emails and things, I know some of you are beginning your journey to trade options. For others, I know that you are at experience. So this is something you actually probably already know. But I always like to healthily challenge a little bit our thinking, our brains, just a little healthily. So even though this explanation may be or may not be fully 100% understood now, when I go over this explanation sometime in the future in a better way, it's not going to be the first time you have seen it, and you're going to be able to grasp it better and sooner. Okay, so hopefully this helped you. Okay, so in any case, what I'm trying to say, and this was because of Mario's question. So Mario, you are guilty about this, my friend. Sorry for that. So the Thank you, Orlando. So yeah, so the reason why I was saying that is because, and now getting back to serious, is because um, remember when I told you options give you options, and there are many different ways to combine things to create different scenarios. And so the key will be now that as we understand better the spreads, I end up providing you with a set of rules so you know how to build the spreads. Okay, and by the way, spread trading is going to take me a few sessions to be able to explain it properly so you all understand. But here's the good news. Okay, and this is a very good news, guys. The moment you understand spread trading, you just got the whole foundation to do magic with options, whatever strategy you want to pick, because everything will be constructed and built in a way where you follow the basic rules that we will learn to do the spreads. Okay, so that's why I'm taking a little bit of my time here to explain this properly. So we all have a very strong foundation, okay? And if any of the things I have been sharing with you, if any of those things I went a little too far, guys, it's okay. We got those sessions recorded, and I would like to ask you guys to go and watch those recordings and refresh your memories. And ideally, you do it next Saturday. So next Sunday before we do it is fresh in your mind, okay? Question from Devan here. So Devan, my strategy, IV is low, buy slightly out of the money spreads. If IV is high, buy in the money spreads to hedge the Vega. Very smart as well, okay? Very smart. Good thought right there. Because here's what's going to happen. And again, oh my God, I so wish, I could snap my fingers and in 2 minutes of our time, share everything we need to know about options trading. Wouldn't that be amazing, guys? But anyway, we need to take a little time to explain it properly, right? But now we are talking about Vega, okay? So we will learn the implications of Vega and how Vega changes depending on the expiration date, but also depending on how out of the money or in the money the option is. And therefore, what Devan is suggesting is it's very intelligent, which is if the options are not very expensive, okay, then you could certainly focus on buying options that are a little bit out of the money, like I have been doing without telling you that. Okay, why? Because remember, if you remember, when we were running our scanner the other day, right? You remember that? What were we looking at in our scanner? Okay, the 50 cheapest option in the market. Okay, and what was I doing? Well, when picking the strike, I was picking a strike halfway between entry and target. That's going to make the strike to be slightly out of the money, okay, which is exactly what Devan has as his rules. Okay, so thanks for sharing, my friend. And again, we'll get more precise with the metrics of the Greeks and everything. Okay, so good job there, and thanks for sharing. We also have here a message from Orlando. Orlando says, oof, this needs further review and numeric examples. I follow it, but not easy to digest. Very good. So you know what? If you are at that point, Orlando, and I don't mean to make anyone uncomfortable, but that's exactly where I need you. Okay, in those sessions, I mean, we only meet one time a week to do sharpening. So I would like to get close to the saturation point where I give you plenty of information without getting anyone falling into, I'm lost, I cannot follow this. But at the same time, getting close to this saturation point so you guys can go and review, and that way, very efficiently with time, next week, that's why I was suggesting to review it on Saturday. So next Sunday, we can keep taking it to the next level. And also, you've been, maybe you didn't think about it, but just to share a little more, maybe you've seen my teaching method, if you wish, or my teaching style. I will give you this long explanation about things, do a lot of writing notes, and then go for the visual. And the next day when we are back, I'll go back to the written explanation and I will review it fast, but I will review it before we go into more. So I will keep mixing the visual and the explanation and the long explanation with the short explanation, with the explanation and the review and the visual, right? And, as we rotate a few cycles doing all of this, we're going to be all fine, Orlando. We are just talking about the most advanced trading asset there is. And therefore, of course, we should expect a little bit of, stretching our understanding, okay? So all good. Yes, yeah, we'll get into the analyzer probably in the future session, Orlando. Okay, no, not today, not today. Good. Let me see a few more questions we may have here. Yes, I believe I've been covering everything. So back to here, back to credit spreads. So what do we have? Well, with credit spreads, we have the same benefit than the debit spreads. Remember, the question was, why do we combine options? Why don't we just buy an option or sell one option on its own? Why do we combine them? Well, for credit spreads, there is one more reason. And I'm going to use the word offset one more time. Okay, but in this case, it's going to be offsetting the unlimited, I need to explain that, the unlimited risk characteristics options sold imply. So what does that mean? And why do we have a scary word here with unlimited risk? What does that mean? Okay, so first of all, everybody relaxes. Okay, so the risk with options is always much less than the risk with the underlying. We just need to understand the risk. Okay, and mathematically speaking, take a look at this. So let's say you sell a put by itself. Okay, you are not doing a spread. You are selling a put by itself. If you sell a put by itself, you just acquired the obligation to buy a stock in exchange to be paid X amount of money. So let's say, for example, that you have sold the 65 put, and this paid you whatever, $110 per contract. So what happens? Well, now you collected $110. You know that as long as the stock remains at 65 or above, that option will expire when it reaches the expiration date. And as long as the stock is above $65 per share, okay, which is right here, right? As long as the stock stays above $65 per share, okay, above this line, then you know you will keep the $110 you collected because the option will expire worthless. The option will expire out of the money, worthless, and therefore the $110 collected will be yours. But what if the stock was to fall below 65? Well, if the stock was to fall below 65, then you will need to fulfill your obligation, and therefore you will need to purchase 100 shares of that stock at 65, and now you own the stock at 65. And from there, two things may happen. The stock may go up, may go down. And if it goes down, it could go all the way to zero. And if it goes to zero, you lost everything. And everything, even though the most you can lose is 65, let's call everything unlimited. Okay, just out of simplicity. Give me a second, guys. Okay, I'm back. So now, here's the problem. Because you could certainly use stops, right? You could sell a put and use a stop on the put. So if the stock is falling and reaches a certain level you have defined based on trading plan, you say, you know what? I am going to buy back that put and close the trade and forget about it. And the trade is over, done. You could do that. Of course, if the market went down, you would need to buy the put back for more than 110. And let's say you paid 210. So if you sold it at 110 and you bought it back at 210, so you have lost $100 in the trade. Why? Because the stock went down below the price beyond which you have a liability, which is 65, because you sold the 65 put. Okay? So again, you would say, well, you know what? Not a big deal. I lost 100. That's what it is. I use my stop. I protect my risk. So even though theoretically I could lose the whole thing because the stock could go to zero, as long as I use stops, I'm fine. But, and that's true, like I would say 99% of the trades, and this is just a made up metric, but you get my point, 99% of the trades probably will work very well like that, where you would use stops to protect yourself. But sometimes, and this happens in the stock market, sometimes stocks gap overnight. Sometimes stocks not only gap, they gap crazy. Sometimes stocks not only gap crazy, they actually go bankrupt overnight. And if all of these things happen overnight, even though you may have stops in your computer system, the reality is that your stops are not going to be able to buy the putback because the stock didn't exist anymore. And when the stock went bankrupt all the way to zero, or when the stop gap 40% down overnight, the amount of pain you would take, it's big enough to call it unlimited. Is that making sense? It would be big enough to call it unlimited. And that's why when we sell options, okay, when we buy options, we don't need to think about it, because when you buy options, when you buy a call or a put, if the price you pay to buy the call is 120, no way you can lose more than 120. Why? Because it cost you 120. So that's the maximum risk you have. Even if you didn't use stops, even if the stock went bankrupt, there is no way you can lose more than 120 if you bought a call and it cost you 120, or you bought a call and you sold a call as a spread and it was a debit spread and it cost you $75. So then the most you can lose is $75. No problem. But when you do credit spreads, you are not focusing on the buying of the option, you are focusing on the selling of the option. And the options you sell have liability, so you could be exposed to unlimited risk. And again, unlimited doesn't need to be unlimited, but it means a lot. So let's call it unlimited. So how can you limit the unlimited risk without using a stop? Because a stop is not a guarantee to limit the risk, because the stock market gaps and stocks may go bankrupt. Well, the only way to offset the unlimited risk characteristics that options sold imply is by buying options against the options you sold. Right? So going back to the example, if instead of simply selling, minus is for sell, instead of simply selling the 65 put, now I get paid 110. Okay, that's great. Okay, being paid 110 is great. Okay, so let's say I collect a $110 credit. Okay, I collect $110 credit by selling the 65 put. Great, but I have an unlimited risk characteristic. How can I offset that? Well, maybe you buy the 64 put against the 65 put you sold. But wait a minute, if I buy, plus is for buy, if I buy, I have to pay. Okay, so let's say I have to pay, no idea, I'm just gonna make it up. Let's say I have to pay 60. If I have to pay 60 to buy the 64 put, okay, and that would be a debit. Okay, that would be a debit, not a credit. So I pay 60, but I get paid 110. Well, I would end up with a net credit of $50 if I'm doing the math correctly, because 110 minus 60 is still 50. So you still collected a credit of 50. You're still making money non-directionally by allowing time to pass. But now, what if the stock gaps all the way to zero? Well, remember, you collected $50 of credit, so keep that in mind. You collected $50 of credit, keep that in mind. Okay, but now because the stock went all the way to zero, okay, what happens? Well, the put you sold, which is the 65, is obligating you, and you're obliged, you have to buy 100 shares at 65, right? And because it went to zero, right? Again, you have this unlimited risk characteristic, but what happened? You don't have the unlimited risk characteristic anymore, because what you have done while you sold the 65 put, you also bought a 64 put. And that gives you have the right to sell your 100 shares at 4. So what's the most you can lose? Well, if you buy at 65 and you sell at 64, the most you can lose is $1, right? So now you know that even if the stock gaps all the way to 0, the most you will lose in this trade is $1. And 100, that's $100. But without the 100 is $1. But for you to have a maximum risk of $1, remember, you have been paid 50 cents. So what is the most that you can lose in this trade? 50 cents. In this trade, there would be no way for you to lose more than 50 cents times 100, $50. Even if the stock goes to 0, even if you chose to not use stops. Why? Because you bought an option against the option you sold to create an offsetting effect, offsetting the unlimited risk characteristic that selling options imply. You limited that by buying an option against the option you sold. You bought the 64 option against the 65 option you sold, and therefore the most you can lose is the difference between the strikes. 65 minus 64 is $1. There's no way you can lose more than $1. So as you can see, it's very convenient to do spreads. It puts you in a much more controlled position, even though we are adding a little more meat to this conversation, and getting you thinking about certain things. And by the way, we'll have to conclude the session for today, because we've been 2 hours nonstop. So you guys are doing a fantastic job, managing this guy on the other side nonstop talking for 2 hours. Okay, so well done from your side. But at least now you have an understanding of what are spreads, the debit and the credit, and why do we combine options together. Of course, you have an understanding of it from a theoretical point of view. I went in the chart a couple of times, but nothing major. So what we'll do is that we'll stop the session for today here, and everybody will go home and enjoy their remaining part of Sunday, and the people that were in Asia will go to sleep. But next time we get together for sharpening purposes, we'll now start talking about the how. Okay, now that we know the what, we'll start talking about the how. How do we put those trades together? And we'll be looking at the market opportunities and putting the trades together. And again, I'm going to start using the word fun again, because it's going to be more fun. And not only that, now it's going to start clicking, because Orlando had a point when he mentioned about the risk profile graphs and all of this. When we start building trade, now that you understand the concept and we start putting it together and you see it visually in front of you, it will click. Okay, but we need the time to explain all of this. Okay, so good job listening, guys. And I have one more question here to share on the main screen from Orlando, by the way. So Orlando, I'm going to read it for the group, and then we will conclude the day. So Orlando, I feel like I understand options trading as I have used them in my investment bucket, as well as purely options trading, but since I do not use them frequently, it does not feel as a second nature to me. I get confused with them, TradeStation options, theoretical analyzer, and that feeling discouraged me to use options. Also thinking about closing the option strategy is something that I need to build in my options trading plan. I also need practice with conditional orders tied to the underlying and the option strategy. I need to practice in the paper account. Once I understand it or feel better about it, maybe we can do a session in the future. Well, it's almost like you're reading my mind, Orlando. This is exactly the plan. Okay, we are going from the theory of it, if you wish, understanding the what it is and the characteristics, to implementing it from a simple type of trading plan to getting into the analyzer and getting very familiar with the analyzer and knowing what to ignore and what to look for, and then of course the execution. Okay, so we'll be doing all of that. Okay, it's just going to take a little time, but we're going to be doing all of that. Okay. Great, wonderful. And Mario, my pleasure, my friend. And your message about having me diverge, it's actually very healthy. Okay, your questions, guys. You guys never stop asking questions. Okay, because in the end, I'm the one choosing to diverge or not. And if I choose to diverge, it's because it's helpful. So if your question is better for us to address it in a different environment, a different session, a different day, an email, whatever, let me be the one to be the one to tell you that. If not, your job when we are getting together here is to be interactive as you are and ask questions, because this is going to be good for you, but also good for the group, and also good for me, guys, because sometimes you'll help me realize certain things that I may have not given you clearly enough or not giving you at all, and I have to give you. So so keep doing that. A pleasure, Mario. A pleasure, everybody, guys. You guys enjoy the remaining part of the Sunday. Good job, everybody. See you soon. See you on Tuesday, isn't it? We have let me double check super quick. Speed of the light. Get together next day is gonna be, I believe, it's on the 12th. Let me see. Get together. Yes, on the 12th is gonna be Tuesday. Short-term trading, guys. See you then. And by the way, we have all the dates for April already in the calendar. So make notes and be ready. Lots of sharpening, guys. Lots of trading. Lots of everything. Okay. Let's take it to the next level. I mean, we get serious with all those sessions, guys. A few months from now, you're gonna be super UFO traders. Okay, so let's do it. Okay, let's make it count. See you soon, my friends. Bye bye. Pleasure.